Welcome back, ladies and gentlemen. It's Benedict here again from Jaginga and Company Associates, and today I want us to do a video about accounting. And the upcoming videos, or rather the videos that we'll do in future, will revolve around finance and accounting. So those of you who are joining for the first time, please take your time and subscribe and stay input, because we want to talk more about accounting, and I hope you'll have some information that you did not understand about accounting. So the video is for everyone, whether you've enrolled for CPA class, accounting class, or maybe you're doing an MBA, or maybe you're just an employer, but you need to know, you need to acquaint yourself with some information about accounting. So here we are. Please sit back, relax, and enjoy what we want to narrate about accounting. So we'll just start by explaining what accounting means. And on my screen here, you can see I've explained accounting as collecting, summarizing, and presenting financial data in a meaningful way. So when you're collecting data, summarizing that data, and presenting that financial data in a meaningful way, we are saying you are doing accounting. But that still looks more vague. So what we mean here, the data that you are collecting and summarizing must be financial data. So when we talk about financial data, we mean that data that can be quantified or measured in monetary terms. And accounting, as we always say, accounting is a business language. So when you hear somebody talking about accounting, so just know that that guy is talking about money. He's talking about business. Accounting is a business language. So let me give you a typical example from a layman's point of view. Let's say you've earned your salary, maybe worth $500. Then from the $500 salary that you've been paid, you want to buy shoes, you want to buy some shirts, maybe trousers, you also want to buy a watch. And then of course you'll also use transport when you're moving from here and there, looking for what to buy. And then you'll also take some little amount to return yourself from the salary that you received. So let's assume you've bought shoes worth $50. You've bought two shirts also worth $50. You've bought two trousers also worth $60. And then you've also bought a phone worth $100. And then we also use transport worth $4. And then for entertaining yourself, you used $30. So after using all that money, maybe come the next day, you are seeing that the salary that you received, you've used so much amount from your salary, and now you want to do an or rather do an investigation on yourself of how you use the amount. So you'll go back to what you bought. You bought some shoes, you bought clothes, you bought some trousers, and then you bought also a watch, or rather a watch, not a watch, but a phone. And then you also use transport. So that data that you'll collect, and then you'll be writing it down that I bought shoes at this much, I bought clothes at this much, I also bought a phone at this much, use transport worth this amount. That statement that you'll be writing down on how you used your money is what we are calling accounting. You'll be accounting for what you earned and what you used. So we are saying accounting is collecting, summarizing, and presenting financial data in a meaningful way. So whatever you are writing down or presenting, it has to be meaningful. And when we talk about a meaningful way, there are two basic ways that we are considering meaningful when you are presenting financial data. So I've said financial data has to be monetary in value. it has to be quantified in monetary terms, or it has to be measured in monetary terms. Is when we call it financial data. So there are two main ways of presenting data in a meaningful way, or rather, there are two meaningful ways of presenting data, and that is through balance sheet and through profit and loss. So when we talk about balance sheet and profit and loss statement, we are talking about business. We are talking about maybe an entity having some operations that generate income. So they must have some meaningful way of presenting their financial data. So the major two ways of presenting data into, rather of presenting financial data is through balance sheet and through profit and loss. So when I talk about balance sheet, in balance sheet we mean a format that shows the financial position of a business. So here I'm saying balance sheet is a format that shows the financial position of a business. So when you start a business, you have capital. That capital you'll put into your business, or rather that money that you are putting into the business, you'll call it capital. And then from that amount that you are putting into business, you'll take a portion of it, buy some assets. You'll take a portion of it, buy some goods that you want to sell. You'll take a portion of it, maybe put in a bank account for some transactions. So the value of those elements, the value of the money in the bank, the value of the assets, the value of the capital, the value of the goods, and that is what we are calling rather when that value is put down in a statement, we are calling the statement a balance sheet. It shows the financial position of those elements that you are using to do operations of your business. And then we also have a profit and loss statement. So profit and loss statement, we are saying, is a statement showing financial performance of a business. Financial performance of a business. Like now you bought goods, you want to sell them, or rather you're selling them. When you sell them, you get money from your customers. And then when you're selling, you must be maybe having employees, you must be paying some other expenses like maybe transport. Okay, maybe you are buying fuel for your car. So all those expenses, when you pay, you'll subtract them from the revenue that you receive from your customers. So what remains can be a profit or a loss. And it becomes a profit when the revenue that you received from your customers is more than the expenses you are paying out. And it also becomes a loss when the revenue you are receiving from your customers is less than the expenses you are paying out. So that's why we are saying profit and loss statement is a statement showing financial performance of a business. The statement will show you whether your business is making a profit or making a loss. So that's all what we mean about profit and loss statement. So the major meaningful ways of accounting is balance sheet and profit and loss. Of course, we have other meaningful ways, but the major meaningful ways, the basic meaningful ways of accounting is balance sheet and profit and loss statement. So let's just move on. And now when you are doing accounting, you don't just do accounting, it has to be a process. Accounting as a language of business must have a process, and the process starts from the source documents. So it will start from the source documents, then it will move to journals, or I've called it journal entry. Then again it will move to ledgers, and then from ledger we'll go to trial balance. Then from trial balance, we'll go to financial statements. And for financial statements here is what we always call final accounts. So final accounts are just financial statements of which are profit and loss, balance sheet, cash flow statement, and statement of changes in equity. So accounting as a process will start from the source documents. So what do I mean by source documents, and what do I mean by journal entry? What do I mean by ledger or trial balance? So let's understand what we mean by these source documents, journal entry, ledger, and trial balance. So we are saying here that documents, the word source documents. A source document is the original document that contains the details of a business transaction. It's an original document that contains the details of a business transaction. So when you talk about a business transaction here we mean the action or reaction between two parties where money is being transferred from one party to the other, or it is an action or reaction between two parties where goods worth value of money are being transferred from one party to the other. So again, we are saying a source document captures the key information about transaction, such as the names of parties involved, amounts paid if any, and the date and the substance of the transaction. So when we hear somebody talking about the substance of this transaction, he's talking about the value of that transaction. The money involved in that transaction is what we are calling the substance of that transaction. So source documents, for an example, I can say an invoice. An invoice will show the name of the client, the date when you are selling the goods to the client, and the number of items you are selling to the client, the price of each item is being sold to the client, and the total amount of all the items that are being sold to the client. And then it will also show the and the terms of payment. Terms of payment, is that payment being done in cash, or is it being done in credit terms? So in cash, you'll be paid in cash. In credit terms, it means maybe you will be paid after 30 days or maybe after 60 days. So that is a source document. So moving on now, we also have a journal. And we're saying a journal is a detailed account that records all the financial transactions of a business. It is a detailed account that records all financial transactions of a business. So here we have source documents that are showing the details of a business. So these detailed transactions from the source documents are what we are recording in a journal. For example, you have 3 customers. Customer A will have invoice 1, customer B will have invoice 2, customer C will have invoice 3. So the details of these invoices 1, 2, and 3 will be recorded in a journal. So a journal is a detailed account that records all the financial transactions of a business. Then again, we also have a ledger. So a ledger here, we are saying a ledger is a book or document in which account transactions are recorded. So here, now we are recording the journal, account transactions. We've said a journal is a detailed account that records all the financial transactions of a business. And then here now, a journal is a book or document in which account transactions are recorded, e.g. purchases ledger, sales ledger, salaries ledger, assets ledger. So when you have, let me give you an example of purchases. You have a purchase invoice. So a purchase invoice is that invoice coming from the supplier. You bought some goods, and then now the supplier is giving you an invoice of what you bought or what you need to pay from the goods that you are buying. So that one we are calling a purchase invoice. You are purchasing goods, so the supplier is invoicing you. So the invoice that you get from the supplier, we call it a purchase invoice. And then the invoice that you are giving to your customer for the goods that you are selling, that is a sales invoice. So with the purchase invoice or sales invoice, you could be having quite a number of suppliers, or you could be having quite a number of purchase invoices or sales invoices. You could have sales invoice 1, sales invoice 2, sales invoice 3. So all the sales invoice will consider them as a class of sales, a class of invoices which are for sales. So we need to record all those sales invoices under sales ledger. So sales ledger will record all the sales invoices, and then purchases ledger will have all the purchases invoices. So when you go to the purchases ledger, you'll be seeing all the purchases from different suppliers, and then with the specific amount and specific items that were bought from these suppliers. The same applies to sales ledger. So we are saying sales ledger, or rather a ledger, is a book or document in which account transactions are recorded. And then lastly here now we are having trial balance. So a trial balance is a bookkeeping worksheet. It is a bookkeeping worksheet. Trial balance is a bookkeeping worksheet in which the balance of all ledgers are compiled into debit or credit account column totals that are equal. The general purpose of producing a trial balance is to ensure the entries in a company's bookkeeping systems are mathematically correct. So all the balances from these ledgers, we have purchases ledger, we have sales ledger, we have salaries ledger, we have assets ledger, we'll be having a creditors ledger. So all the balances of those ledger, of which they could be in debit balance or credit balance, will be transferred to a bookkeeping worksheet, which we call trial balance. So the trial balance will show the total of all the credits and the total of all the debits, and these totals are supposed to be equal. Now for you to ascertain that the accountant that has been working on the source documents through journal, ledger, and trial balance has done a tremendous job is by having a trial balance being mathematically correct, and it will be mathematically correct when the trial balance is balancing on both sides. It is balancing in terms of debit balances are equal to credit balances. Okay, and then they have been correctly captured, or rather the balances have been correctly captured to the ledgers. So now we'll be talking of bookkeeping being mathematically correct. So again, let me talk about bookkeeping. When you are employed, you're an accountant, or maybe let's just say you're an accountant, but what you are doing has been confined from source documents to trial balance. So whatever you are doing from source documents to trial balance, we call that one bookkeeping. Of course, you'll be an accountant, and the level of what you are doing is just for bookkeeping. So bookkeeping is elementary part of accounting, where you only work from source documents to trial balance. So again, let me take you back to an accounting process. So we were saying from source documents, you go to journal entry, rather journal, you go to ledger, then trial balance. Then after trial balance, now you need to move to financial statements. So generating financial statements or coming up with financial statements, it's now more advanced way of accounting, where now you are not doing now you are past the bookkeeping. You've done source documents to trial balance. Now from the trial balance, you'll you'll generate your profit and loss. You'll also generate balance sheet. You'll generate cash flow statement, and then you'll also generate statement of changes in equity. So financial statements here are profit and loss, balance sheet, cash flow, and statement of changes in equity. And then we had said earlier that profit and loss statement is a statement that is showing the performance of a business. So is the business making a loss? Is the business making a profit? It shows the financial performance of a business. And then when you talk about a balance sheet, it shows the financial position, the position of your business. What are the values of your creditors? What are the values of your debtors? What are the values of your share capital? So it shows the financial position of your business. And then we also have here a cash flow statement. So when you talk about cash flow, talk about money coming in and money going out. So when the customer pays you, money comes in into your business. That one we call cash inflow. When you pay expenses, you are paying salaries, you are paying fuel, you are paying transport, you are paying rent. Cash is going outside your business. So that one is a cash outflow. So when you come up with a statement that shows how cash came in and cash went out and what remains in your business as cash in hand or cash at bank, we call that statement cash flow statement. And then lastly, we are having a statement of changes in equity. So statement of changes in equity, let me start by saying when you inject, when you put money into your business, that money that you are putting into your business, you as an individual, call it capital. The amount that you are injecting into the business is called capital. After injecting money into the business, you will also do your business operations. You will sell your goods. You will also have expenses you'll be paying. So when you sell your goods, customers will pay you. And then when you pay your expenses, money will be going out. But when customers pays you, money come in. Rather, when you sell your goods, you'll be saying you've received revenue. You've earned income from from the sale of your goods. So when you take revenue and you net off your expenses, or when you take your revenue and you subtract all your expenses, what remains can be positive or negative. When it is positive, we call it profit. When it is negative, it is a loss. And then we've said that it becomes negative when your expenses are more than your revenue, and it is positive when your revenue or what is coming in from your customers is more than what you are paying out as expenses. So when it is more, you'll get your net profit. And net profit, when you don't use it, after paying all your expenses, you don't use your net profit. You carry it over to the next period. Maybe your business operations was in January. Now you are carrying forward your net profit to February. You'll be carrying on with the operations of the business in February. So the net profit you are carrying forward to the next period, we are calling retained earnings. So when you add retained earnings, you add to your capital, the amount that you injected into your business. The two we are calling equity. So equity is a summation of capital and retained earnings. So any change, whether positive or minus, is what we are calling the statement of changes in equity. So when you come up with a statement showing how the changes happen to your capital, how the changes happen to your retained earnings, so we call that statement of changes in equity. So I hope you understood, and let's move on. So now let's move on to branches of accounting. Accounting has various branches. So when we talk about branches of accounting here, we mean financial accounting. We also mean cost accounting. We mean management accounting. We mean tax accounting. We also mean social responsibility accounting. So what comes to your mind when somebody is talking about financial accounting? So financial accounting will involve the preparation of financial statements from trial balance to final accounts. So when you see somebody saying I'm doing financial statements, I'm doing cash flow, I'm doing profit and loss, I'm doing cash or other statement of changes in equity, I'm doing balance sheet, is doing financial accounting. So when you talk about cost accounting, what should come to your mind is something associated with costing. The services that you are rendering, how did you price them? The products you are selling, how did you cost them? The products that you had manufactured, what was the amount of labor the value of labor that was involved? What was the value of raw materials that was involved? What was the value of maybe machinery that was involved in coming up with the product before you sell it? So that's where we are talking about cost accounting. And then when you come to management accounting, we are talking about that information that you are giving, the information from your operations, so maybe from your products, maybe from your financial statement, maybe from your sales, maybe from your suppliers. That information that you want to give to the management to aid their rational decision making is what we call management accounting. So let me just take you to proper explanation of how I've explained what financial accounting mean, cost accounting, management accounting, tax accounting, and social responsibility accounting. So here we are saying that financial accounting is that branch of accounting that involves the recording of transactions geared to the preparations of trial balance and final accounts. So when you are involved in recording transactions that are geared to preparation of trial balance and final accounts, we call that one financial accounting. And the final accounts here we mean profit and loss statement, balance sheet statement, we mean cash flow statement, we mean statement of changes in equity. So this four here is what we call final accounts. So when you hear somebody saying I'm doing the final accounts, know that is trying to prepare profit and loss statement, balance sheet, cash flow, and statement of changes in equity. So again, we are saying cost accounting is the accounting discipline. It is a discipline which deals with costs. So when you hear somebody talking about cost accounting, he's talking about costs. He's talking about the unit cost of goods produced and services provided. It helps the management of the organization in fixing the price, controlling the price, and providing relevant information for the purpose of decision making. The information being provided to the management has to be relevant for the purpose of decision making. So that one will be talking about cost accounting. So here also we have management accounting. So management accounting, here we are saying the accounting system which supplies necessary information to the management for rational decision making. So when the decision is irrational, or rather when the decision is irrational and the information is unnecessary, we cannot call that one management accounting. And then we are saying the information may be concerned with funds, costs, profit and losses, and so on and so forth. So the information being provided here can come from cost accounting, or the information being provided here can come from financial accounting. And the information being provided here in management accounting, it is being provided to aid rational decision making. And when we move to tax accounting, here we are talking about the government. You always hear the government asking people to pay their taxes. You always hear about tax returns. So when you hear about tax returns, payment of taxes, value added tax, excess duty tax, corporate tax, we are talking about tax accounting. So corporate tax will be a portion of your net income. After doing your operations, you've come up with your profit and loss statement. There's a way you're supposed to calculate tax that you need to pay the government. So here we'll be talking about tax accounting. And then lastly, we also have here social responsibility accounting or social accounting. So social accounting is saying this is branch of accounting is commonly termed as social responsibility accounting. It aims at unveiling the facilities provided by the entity to the society in terms of medical, housing, education. So when a business entity decides to provide the society or the environment in which it operates, it want to provide them with medical, housing, education, and so on and so forth. We call it social responsibility accounting. We are being socially responsible to the society by giving them housing, medical, and education. So we call that social responsibility accounting. Hope you guys understood, and I hope you guys are enjoying what we are talking about. So let's move on to basic elements of financial statements. So financial statements, we've talked about profit and loss, and then we've also talked about balance sheet. We've talked about equity. We've talked about cash flow statement and statement of changes in equity. So when I talk about statement of changes in equity, the element that is involved here is the element that will be involved in a statement of changes in equity is this equity. When we talk about profit and loss statement, there will be two elements of financial statement that will be involved, and the two elements will be revenue and expenses. So when you net off your expenses from revenue, or when you subtract your expenses from your revenue, you will be getting your net income or net loss. So earlier we had said that a profit and loss statement is a statement showing the performance of a business. It shows whether the business is getting profit or the business is getting losses. So these two elements of financial statements called revenue and expenses are what forms statement, or rather the profit and loss statement. And then when we talk about a balance sheet, we have a balance sheet. Now we have three elements involved. We have assets, we have liabilities, we have equity, and then of course we also have net loss and net profit. So we have 5 elements to financial statements. So let's understand what we mean by these elements of financial statements. So we are saying here that we have basic elements of financial statements, of which one is revenue, and then we are saying revenue is an increase in economic benefit during the accounting period in the form of inflows. It is an increase in economic benefits during the accounting period in the form of inflows. Simply put, when you sell services, or you sell goods to your clients, you sell goods to your to your customers, they will pay you. So whatever they are paying you is an inflow to your business. So that is what we are calling revenue. It is a economic benefit that is coming into your business as an inflow. So whatever they are paying to the business, the customers, is coming into your business as an inflow, and then it is an economic benefit to your business. And then now again we are saying here that expenses, or rather an expense, is a decrease in economic benefit during the accounting period in the form of outflows. So when we are talking about accounting period, we are talking about the period within which you've decided to account for your business. So it is a period within which you can always come up with the statements, maybe balance sheet or profit and loss. So let's say you are doing a business in the month of January. After the end of the January, within that period of January, you'll do your financial statements, you'll do your balance sheet, and you'll do your profit and loss. So we are saying expenses rather than expense is a decrease in economic benefit during the accounting period in the form of outflows. So within that January, you'll be paying expenses, and expenses will be taking money outside your business. So the payment will be an outflow of cash from your business. That's why we are saying it is a decrease in economic benefit. So your economic benefit here was the revenue you're getting from the customers. So when the revenue was coming from from your customers as economic benefit by selling your products, there is also a decrease of that economic benefit in terms of expenses that you are paying out. So that's what we mean by expenses. And then now also we have assets, and we are saying assets are resources controlled by an entity. So when we talk about an entity, we just mean the business. Entity is just that business environment of yours where you operate your business, or rather not the society where you operate your business, but that area that you've secluded, that this is where now I want to do my business, this is where I'm putting my assets, my goods, and yeah, this is where I'll be doing my business. So that's what we are calling the entity, the business itself is what we are calling here the entity. So we are saying assets are resources controlled by the entity as the result of past events and from which the future economic benefits are expected to flow into the entity. So let me explain this with a simple example. You bought an asset, rather you are buying an asset today, or rather let's assume this is January. So you are buying an asset in January, you want to start a business of car hire. So when you buy an asset in January, that date that you are buying an asset, or rather when you are buying an asset, we are calling it an event. It is an event of buying an asset. So when you buy an asset today, come maybe tomorrow, come maybe February, you want to hire this asset out, you want to hire this car out, so that whoever you are hiring to will be paying you some amount when they take asset and use. They will take the car, they use it and pay you. So there will be an inflow to your business in terms of the revenue that you are being paid by your customers. So that inflow, we are calling it the future economic benefit. So it is future economic benefit in the sense that you've hired the car, and this guy, after using the car, will pay you. So whatever will be paying you will be an economic benefit that will be flowing into your business. So we are saying assets, or other assets, are resources controlled by an entity as a result of past events and from which the future economic benefits are expected to flow into the entity. So the asset has to be controlled by the entity. Let's say you've also taken a car hire, or rather you've bought a car under loan, or you've bought a car under car hire, and this car that you bought under car hire, you can control it, and by controlling it here, you can as well hire it out to somebody so that they can give you money after using the car. So when the car is under your control, you still call it an asset, or rather when the car is still under your control and then you can still use it to generate some income, we call it an asset. So again, let me give you another example that will give a difference between what we always call an asset and what we should call a liability and not an asset. You bought a car, you are using it just to transport your family. Maybe you're just using it for personal use. You use it from your place of work to home, or maybe from home to place of work, or maybe to carry your friends to maybe a different venue. But there's nothing you are getting from that car in terms of income. So what you are getting from the car is zero. You bought the car maybe on a loan. You also have interest on that loan. You pay the insurance to this car. You pay repairs to this car. And then you also have some scheduled maintenance of this car. So money is outflowing from your pocket when you use this car. So this car, most of us will call it an asset, but in the actual sense, or in accounting terms, this whatever you are calling an asset will not be an asset. It is a liability because it's only taking money from your pocket. But I'm not saying that people should not buy cars. I'm only trying to explain so that you can understand the difference between an asset under liability. So let's move on to liability. When we talk about liabilities, we are saying liabilities are the present obligations arising from the past events, the settlement of which is expected to result in an outflow from entity resources embodying economic benefit. So a simple example here that will make you understand is you've taken a loan, and the loan is also having some interest in it. So you must pay the loan plus the interest. So the loan you are paying, maybe you are paying after a period of 5 years. So on a monthly basis, there's something you must pay the bank in terms of the loan, rather the interest. So that is an obligation. It's an obligation arising from past events. The past events here is when that loan was given. The settlement of which is expected to result in an outflow. When you're paying the loan plus the interest, that one is an outflow from your business. This is an outflow from your business or from the entity resources. So that's the meaning of liability. Then lastly here now we want to talk about equity. So we mentioned that equity is the summation of retained earnings and capital. The capital that you inject in the business, then you do the operations. The operations, you got your net profit, and net profit plus that capital is what we call equity. But here we are saying equity is the residual interest in assets of the entity after deducting all its liabilities. So when you take all your assets, you subtract all your liabilities, you should be getting equity. Okay. So when you get money into the business, this capital. So this money you buy assets, you buy goods that you want to sell. These goods are assets. The physical assets are also assets. And then the goods that you are buying again, maybe you bought them on credit, so you have a liability against suppliers. Or maybe you've also taken a loan to buy these assets or to buy these goods that you want to sell. So this loan is a liability. Then the assets are assets. You have asset of cash, you have a fixed asset, or rather the cars, the capital assets, I mean. So the assets here, when you deduct liabilities, I mean the amount you're supposed to pay your suppliers or the amount you're supposed to pay your creditors or your bankers, you net off from your assets, you'll remain with equity. Okay. So that's the explanation, a simple explanation or elementary explanation of what equity is all about. So ladies, I hope you're understanding and I hope you are enjoying what we are doing. So I don't want us to move on to parties interested in the financial statement. So I just want us to do a recap. So this one will start in the next video, parties interested in financial statements and rules of debit and credit. So when we come to the next video, we'll talk about parties interested in financial statements and what is meant by debit and credit and what are the rules about debit and credit. So let's just do a recap of what we've talked about. We've talked about the meaning of accounting, and we've said collection and summary and presentation of financial data in a meaningful way. And the meaningful ways, the major meaningful ways or the basic meaningful ways of of accounting is balance sheet and profit and loss. And then again, we've also said accounting is business language. So when somebody talks about accounting, you know that guy is talking about business language. He's talking the language of business. So the language of business is accounting. And then again, we said that accounting is a process. You just don't wake up and say, now I'm doing accounting. It has to start from source documents. It goes to journal, it goes to ledger, it goes to trial balance. And those who are working from source documents to trial balance, we call them bookkeepers. The accountant, yes, but what they are doing is elementary part of accounting, so we call them bookkeepers. Then after bookkeeping is now we come with financial statements, of which we call profit and loss, balance sheet, cash flow, and statement of changes in equity. And these four financial statements, we call them final accounts. And then we've also explained what is meant by source document, journal, ledger, and trial balance. And then we've also explained what is meant by branches of accounting. And we have 5 major branches. We have financial accounting, cost accounting, management accounting, social responsibility accounting, and tax accounting. So we've explained the branches, and then we've also talked about the basic elements of financial statements, which are revenue, expenses, equity, liabilities, and assets. And then when we talked about the major meaningful ways of presenting financial data, we talked about balance sheet. So we have 3 elements here of financial statements that form part of balance sheet, which is equity, liability, we have equity, we have liability, and then we have assets. So this form part of balance sheet as a major meaningful way of presenting financial data. And these are the 2: revenue and expenses are elements that fall into profit and loss statement as a major meaningful way of presenting financial data. So ladies and gentlemen, I want us to stop at that level. Then when we come to the next video, we'll talk about parties interested in financial statements. And then again, we'll also talk about rules of debit and credit with various examples. So thanks for watching, and let's meet again in the next video.